Good afternoon, everyone. Thank you for joining today's webinar from Esgian. Today, my colleagues Cinnamon Idrin and Sarah McLean will be talking about the jackup market and the outlook. So over to you, Cinnamon.
Thanks, Barry. Hello, everyone, and thank you for joining us for today's Esgian Rig Services webinar. This presentation is on the global jackup market. As Barry mentioned, my name is Cinnamon Edgerlin, and joining me today is Sarah McLean. We'll start with a quick introduction for some of you, or what may be a refresher for our returning registrants. Then I'll go over some market trends and update you on our latest upgrade to our emissions database before turning it over to Sarah for some select regional analyses, our market outlook, and the conclusion. Jumping in with our introduction, Esgian has three primary components: our GreenPack ship service, our offshore wind analytics service, and our offshore rig service. The rig service is comprised of three segments: analytics, values, and emissions. Data from our rig services suite was used to inform today's presentation. On this slide, we've listed our 8 colleagues within the rig services team. You'll see each of our names is labeled with one or more segments: Rig Analytics, GreenPack Rigs, which is our emission service, and Rig Values. The team is located across the US, the UK, and Norway. Now moving into our market trends section. Here we have 2 snapshots of the global jackup fleet. On top, the chart is arranged by the 10 regions with the most rigs, and on the bottom, the chart is arranged by the managers of the 10 largest fleets. Here I want to point out that in some cases the owner is not the same entity as the manager, and for this slide we are focusing on who has responsibility for managing the rig. Not surprisingly, the Middle East has the largest fleet, both overall and when limiting the selection to the drilling segment, which is in light blue. The Far East, which comes up next, has the most units under construction due to the majority of the jackup yards being located in China. So many of the new builds that were stranded during the downturn remain in the region, along with the units that are progressing towards delivery. But even when filtering out the yet-to-be-delivered rigs, the Far East still has a commanding presence in the jackup market, with 43 units under contract. The third largest region is Southeast Asia. This region has the second highest count of rigs under construction and also has a large number of idle rigs, leaving Southeast Asia with just under half its fleet working. When taken as a whole, 97% of working jackups are located within these 10 regions. Interestingly, even though the Middle East has the largest fleet, the biggest manager is actually from the Far East, the state-run China Oilfield Services Limited, or COSL, which has 42 jackups under its management. Outside of the Far East, COSL also operates jackups in Southeast Asia, the Middle East, and Mexico. In terms of fleet size, Borr Drilling comes in next. The company has a diverse footprint with rigs under contract in 5 regions: Mexico, the Middle East, the North Sea, Southeast Asia, and West Africa. Borr currently has the most undelivered units at 5. However, on Monday, the rig contractor announced a binding letter of intent to sell 3 of these to an undisclosed buyer. Closing of the transaction is expected within 30 days. Because the transaction has not closed yet, it isn't reflected on this slide. Once the transaction does close, Borr will drop from the second slot to at least 4th, depending on who the buyer is, as the next few managers on the list are all fairly close in numbers. Also not reflected on this slide is the sale of 5 Noble jackups to Shelf Drilling, which was announced last week and is likely to close late in Q3 in connection with the pending Noble-Maersk merger. For now, the third largest jackup manager is Valaris, which actually has a stronger drilling count than Borr, but also has some cold-stacked rigs. Half the managers on this chart have at least one cold-stacked rig. Together, these 10 managers represent almost half the global jackup fleet. As mergers and acquisitions continue, expect most of the companies on this chart to build their positions. Given the steep rise in oil prices over the past year, would be remiss not to show how the global demand trend has followed the oil price. In January of last year, Brent averaged almost $55 per barrel. That has since more than doubled to about $113 per barrel for the month of May. Over the same period, jackup demand grew from 297 to 319. We're expecting jackup demand to keep climbing in the short to medium term, not only in direct response to higher oil and natural gas prices, but also as a result of increased energy security concerns around the world following Russia's invasion of Ukraine earlier this year. Sarah will have more on our demand outlook and some challenges in meeting all of the demand later in the presentation. Unsurprisingly, as demand has increased, the stacked fleet has decreased. May 2022 ended with 48 fewer stacked jackups than we had at the beginning of 2021. The warm stacked fleet is down by 30, the cold stacked fleet is down by 18, the number of rigs under construction dropped by 7, and the number of rigs under contract has increased by 22. When accounting for all of the additions and subtractions to the global jackup fleet, the supply is down about 30 units since January 2021. While there is still a meaningful stacked fleet to pull from to fill demand, the remaining units have been rather picked over by this point. Over 80 units are hot or warm stacked, but many of these have already been spoken for and will return to work over the next year or so following reactivations and transport in some cases. Expect to see many rigs being moved to the Middle East in order to meet this region's growing appetite for rigs. Meanwhile, of the nearly 60 cold stacked jackups, fewer than 20 are younger than 30 years old, and a small handful of these have recently changed ownership and are expected to be returned to work within the next year or so. While new builds stranded at shipyards without proper ownership are an obvious source for more supply, given the recent consolidation we've seen among shipyards and their turn towards the renewables industries, fewer shipyard slots will be available to build new rigs. Plus, the ongoing global supply chain crunch would mean longer than usual lead times for parts, and therefore longer deliveries. We may see contractors looking for alternative solutions to obtain supply quicker. Notably, we have already seen one instance in which a rig that was sold to a scrapyard a couple of years ago is being purchased to be reactivated and returned to drilling. As the reasonably available fleet shrinks, we may see more units that were previously deemed retired or scrapped following the 2014 downturn become more attractive and make their way back into the market. Similar to a couple of slides back, the Noble Shelf and Bore undisclosed sales have not been finalized yet and are not included on this slide. That being said, 24 jackup sales have been finalized since the start of this year, and only 2 of these have been for recycling and none for conversion, leaving 22 sales within the drilling industry in just the first half of this year. One of the rigs sold for recycling was built in 1969, and the other was built in 1976, so both units were over 45 years old and due for retirement. For comparison, total jackup sales for full year 2021 was 39, broken down to 18 sold for recycling, 4 for conversion, and 17 within the drilling industry. So while recycling and conversions are way down, sales for drilling have already exceeded last year's count and will be going up even more. Values go hand in hand with sales, and our rig values team sees jackup values continuing to rise. In just the past month, the global fleet value has risen by about 1.1%. And over the past 12 months, we've seen an increase of 56.1%. Narrowing the focus to just those units delivered within the past 10 years shows an increase of 55% in the past year. Here we'll highlight some work from our emissions team. According to their model, jackups have emitted about 488,000 tons of carbon dioxide, or CO2, in the past month. The two charts on this slide show modeled emissions over the past month by the 20 managers with the most emissions on the left and by the region on the right. The blue bars represent total CO2 emissions, while the green dots represent the average CO2 emissions estimate per working rig. Of course, Coastal is the manager with the most emissions because, as you saw a few slides back, it has the most working jackups. And the Middle East is the region with the most emissions, as it has considerably more units working there than anywhere else in the world. An exciting new addition to our emissions database is called solution analysis. You can see a sample screenshot on this slide. For example, the rig used for this exercise has the Siemens ESS Blue Vault installed, so that solution is automatically checked. This is seen in the middle column, the third red circle down. A user could then tweak other solutions to see what kind of an impact they would have on the potential drilling program they specified. In this scenario, NOV PowerBlade was added as an upgrade. This is in the middle column, the second circle down. The circle at the bottom of the slide shows where the user can adjust local costs for fuel prices and emissions taxes. And here you have the result from your input. This tool will give you an economic picture of your return on investment from fuel savings and emissions reductions. So you'll be better equipped to understand if investing in a certain technology would result in the reductions you seek. And with that, I'll turn it over to Sarah for the remainder of the presentation.
Thank you very much, Cinnamon. So as we mentioned in this next section, we're going to take a closer look at some key regions in the global jackup market, then a broad overview of the global demand outlook, and some of the things that we need to be taken into consideration alongside it. So as the most active region in terms of tendering and fixture activity, the Middle East has definitely been the headline grabber so far in 2022. Saudi Aramco remains the biggest driver in the region, with 39% of the current active fleet within the region and 3 of the most significant tendering exercises globally. So far this year, we've seen at least 30 new charters and extensions to Saudi Aramco, and with that, we've also seen a significant uptick in contract durations and day rates in the region. For contract durations, they've gone from mainly around 200 days to over 1,000 days, while rates have risen from between 60 and 80,000 a day to between 95 and 120,000 a day. Aside from Saudi Aramco, ADNOC, as the second biggest player in the region, has also bolstered its own fleet by at least 10 units in the past year, with more to follow. Qatar has also seen a ramp up, bringing in a number of rigs from outside the region with the potential to see additional capacity. If we look at the main demand chart at the top of this slide, I'll explain this a little further. The green section of the bars shows all of the demand, including fixed charters, options, firm and potential requirements, while the blue line shows our forecast for competitive utilisation, competitive rigs which are being marketed, available and working, not the cold fleet. Demand looks set to remain high up until the end of 2024, up to potential 151 units. I say potential as there's still some leeway about how many units Saudi Aramco will take on from its recent tenders, and also how many rigs could be acquired by ADNOC as well. You can see utilisation drops a little due to charters coming to an end, but it will pick up over time as contracts are extended, options are exercised, and we start seeing more awards. The number of rigs in the sector is rising as demand is fulfilled by rigs coming from elsewhere, including new builds and reactivations. Moving on to the next busiest regions, the Far East, India and Southeast Asia. Within APAC, 42% of the jackup fleet are committed in China, with the bulk of this activity bareboat chartered by COSL and then committed into renewable contracts with Chinese NOCs. As such, we don't see a particularly high amount of new tenders as it's relatively closed off. Exploration is a big driver of China in the near future, with a total 227 exploration wells expected to be drilled by Sea Norway in 2022, and that momentum set to continue in the coming years. In India, where 25% of the APAC jackup fleet is located, ONGC also has a strong focus on exploration, with the rig count expected to ramp up to meet this boost between 2022 and 2025. The latest exploration budget of approximately $4 billion sees 150% growth over the previous budget. Like China, we expect much of the contracting in India to be dominated by renewals and extensions. In Southeast Asia, the regional hotspots are Malaysia, Thailand and Indonesia, with the recent uptick of activity for Vietnam. Looking at the chart below, a lack of recent fixture activity in the Far East means I've chosen to focus on Southeast Asia and India for contract durations and day rate notes. In Southeast Asia, rates have risen from just over 70,000 a day to just over 90,000 a day. Since last November, fixed contract durations have also trended a little higher than they had been over the bulk of 2021. In India, day rates continue to trend low when compared to the rest of the world, going from around 40,000 a year ago to just over 42,000 in June 2022, but we have seen some fixtures as high as 50,000. Contract durations are also significantly higher in India, with between 1 and 3 years the norm. There are 30 units under construction in the APAC region, but demand is now increasing for these units, particularly from the Middle East, and some small potential for rigs in China to be snapped up for conversion to be used in offshore wind. I think it's fair to say that the North Sea has been in a bit of state of flux in 2022. At the end of 2021, following COP26, the focus was very much on reducing oil and gas activity. Then when sanctions against Russia brought threats to energy security in Europe, focus again turned back towards ramping up drilling activity. But in the UK, the windfall tax has added an air of uncertainty around these ONG projects, especially for independents. At the moment, it's unclear which projects will end up shelved, if any. On the flip side, we have been seeing some turnaround on projects like Shell's Jackdaw gas field, which now has the green light to go ahead after previous rejection. As it stands, much of the limited demand we've seen coming out has been for the UK, with a significant portion coming from the Netherlands and still some unfulfilled demand for Denmark. Norway has had a quiet year, but towards the end of 2022 and the beginning of 2023, the market expects things to pick up there significantly. Looking at the contracting trends, there isn't too much to see for Norway. Only one significantly long-term charter was awarded around the turn of the year, but the fixtures since then have all been for well under a year in most cases. Rates in Norway have also been down a little compared to this time last year. In the rest of the North Sea, contract durations also remain low, with the vast majority of scopes coming in at under a year. Rates have begun to trend up a little again at last, though, after some small decline over the past year. The region's also anticipating some fleet movement, with rigs already lined up to leave the sector for the Middle East and Mexico, and the potential for others to follow as they're bid into busier markets. The biggest shake-up, however, will be from the ongoing Noble and Maersk merger, where the UK's Competition and Markets Authority put the brakes on with its decision that it would lessen competition in the region. As such, a remedy proposal of selling 5 jackup units was proposed. The sale's now been agreed, with 5 Noble units heading to a newly formed subsidiary of Shelf Drilling. This means there will be a new player in the region if everything gets the green light. In West Africa, we expect to see some gradual increase in demand at the end of 2024, with a corresponding rise in competitive utilisation, potentially even entering the mid-90s during 2024 due to the commencement of long-awaited longer-term programmes in the likes of Nigeria and Angola. For now, though, the market has been quiet, with very few tenders issued this year. Interestingly, we're seeing some demand from some countries that rarely see jackup activity, such as Côte d'Ivoire and Ghana, but for the most part, demand is coming from established markets. Nigeria has the most demand at the moment, but with projects moving very slowly. A number of tenders have been placed on the back burner from international super majors, while work from local entities is also taking a long time to reach award due to a combination of funding and moving through red tape. As it stands, there are 2 dominant contractors in the region, Borr Drilling and Shelf Drilling, with this trend likely to continue in the near term. As with other global regions, we're expecting some of the fleet to potentially leave the sector for the Middle East, but as demand rises, there's potential for reactivation of units within West Africa for work in West Africa. Contract durations have been decreasing over the course of the year, though you can see from the chart fixturing activity has been patchy. But all fixtures made so far in 2022 have been for scopes under a year long. Day rates have been rising steadily, however, going from around 75,000 this time last year to between 85,000 and 95,000 today. We are expecting to see 100,000 a day rate fixed by the end of the year, though. The final 2 regions we'll look at in depth are Mexico and the US Gulf, starting with Mexico. Again, we see a gentle rise in demand in the top chart, with competitive utilisation potentially hitting the mid-90s by the end of 2024. There are a large number of jackups rolling off charter during the rest of 2022 and 2023, but we do expect that many of them will be renewed. We should also note, however, that while Pemex continues to have bold drilling ambitions, these are not always fully realised. Other things that we expect will affect the near-term future in Mexico is the outcome of Zama, which, despite being a floater project, could have potential widespread implications for other projects, including jackup programs. So foreign players are keeping a close eye on that one, and there are also no new lease sales expected under the current administration. In terms of recent trends, day rates have gone neither up nor down over the past year, with an average rate of 73,000 a day in the benign fleet and 80,000 a day in the harsh fleet, and most new fixtures are coming in under 300 days. Finally, despite it being a less active jackup region, we did want to mention the US Gulf of Mexico, as there's been a slight upswing in activity there. This is due to the increased natural gas prices and expectations to export more LNG to Europe that could support the reactivation of at least 1 unit later in the year. This does have the caveat of the recent fire at the Freeport LNG facility, as the lengthy repair timeline may dampen some of the near-term demand. Otherwise, we'll continue to see P&A opportunities in the region due to the mature market, but also fewer extensions being granted. Average contract duration in the region is under 225 days, with rates around the 75,000 mark, but because of rising costs, we recently also saw a fixture in the low 90s. Finally, here's an overall picture of what we see globally. We have a fairly steep rise in demand led mainly by the Middle East going into mid-2023. Then we see some stability through to end of 2024, with competitive utilisation currently forecast to be around 87% by the end of the period. This is up from the 75% we forecast for next month. Of the regions not mentioned, we're still expecting rises in demand in South America, where we anticipate 4 jackups to be working by early fourth quarter, Oceania, where jackup demand rises to 5 units in early 2023, and the Med and Black Sea, where there's an uptick in demand expected across the region, but also a likelihood that we'll see some of this work continue to be deferred. But this uptick in demand is not without its challenges, and we could probably sum this up as saying optimism being tempered by practicality. The previous downturn resulted in loss of experienced and knowledgeable personnel, many of whom are now reluctant to return to the cyclical industry. This applies to both onshore and project staff, as well as offshore crew. The COVID-19 pandemic led to global supply chain issues, and many parts now require long and growing lead times for orders. The sustained high oil prices mean rising fuel costs now need to be factored into project costs. Some rig moves may be reconsidered, leading to the decision to wait for local rig to become available, or potentially just delay the programs. Global inflation is also being felt across the board, from increasing labour costs to the cost of parts and services, which may put pressure on the reactivations we need to meet some of this demand. So to conclude, I guess the key takeaway from today is the market's trending up in terms of demand and rig values, but some challenges remain. 97% of working jackups are found in the 10 largest regions, with the Middle East, Far East and Southeast Asia dominating. COSL, Bar, Beladis and Shell are the largest jackup managers, but ADES is close behind following recent acquisitions. Demand has risen from 297 to 319 rigs over the past year, which coincides with the doubling of the oil price. In that time, the stacked jackup fleet has shrunk more than the drilling count has grown. This may see more retired or scrapped rigs return to the active fleet. Rig values are going up. The value of the fleet has risen by 56.1% in the past 12 months, and demand is rising. Global competitive utilisation is expected at almost 90% in early 2024. But increased demand does come with its own set of challenges, as we saw in the previous slide. That concludes our presentation on the jackup market for today. Thank you very much for your time.